Let us wrap the week. Main goal on Friday: two things. Number one, wrap the week. Look at how the markets have changed. The second piece is going to be opening the final bar mailbag and answering some of your questions. But we wanted to start it out with our wrap the week segment. We're going to start with today with a poll. We always have a poll running on our live stream page on StockCharts.com. Also on social media, we'll send a poll around and encourage you to participate. We asked you just this week, which asset class performs best through the end of this year, December 31st, 2021. I gave you four choices, and by far the winner with 2/3 of the vote, stocks in the form of the SPY, was 68% of the vote. Gold got 17% of the vote. The US dollar got 10%, and bonds only got 5%. So two things that I would answer. Number one, I'm super encouraged, Final Bar Nation, for answering really in the perspective of the trend. Out of those four, which is having the strongest consistent uptrend, it's undeniably stocks, which have continued to push higher. Well before today, you've seen that persistent uptrend in the S&P holding its 50-day. So I like what you're seeing there. Gold number two, which is interesting. Gold has actually rallied pretty good today. And Leslie Juflas, one of my guests on the pitch earlier, talked about gold, particularly Newmont Mining and the materials sector, as starting to show some encouraging short-term signs. And I think that's certainly an area to watch. My contrarian hat is buzzing, or my ears are buzzing, thinking of bonds where no one likes it. I'm always interested in things that no one else likes, because that can be an interesting contrarian play. But it's interesting, the stock to bond ratio very much favoring stocks once again, given the strength that we've seen to end this week. Let's continue our Wrap the Week segment looking at the Wrap the Week chart. This is a chart looking at the weekly returns. So it's starting the clock last Friday at the close on the 20th and finishing today at the close. Will show how all these major asset classes have evolved. The labels are up in the upper left. Might be a little hard to see. So if you follow along my voice and the mouse, you can see what has done what. The S&P 500 with the strength today, finishing the week higher 1.5%, which is a pretty nice upside follow-through week. We've certainly seen, some signs of potential weakness. We've seen weakness in individual stocks and groups, but not on the broader indexes, which continue to push higher. So what underperformed stocks this week? Three of our major asset classes. Number one, bonds. The TLT was down 0.7% this week. The US dollar here in green down 0.9%. And then the worst performer of the group, Bitcoin, down 2.3%. It's interesting, if you look at the chart of Bitcoin this last week, kind of trending downward. Overall, this is after a pretty significant rise, with Bitcoin reaching back up to 49,000-50,000. So certainly something to watch, and you're seeing renewed strength today. Interesting to see over the weekend if that continues, given the very much risk-on feel that we had on Friday's session here for other assets. Everything else outperformed the S&P this week. Gold is here in the gold color, up 2.1%. In pink, we have the NASDAQ 100 up 2.25%. In orange, we have emerging markets up 4.2%. That's actually a really interesting one, because emerging markets have consistently been at the bottom or near the bottom of the list. It's actually pretty unusual. You're seeing renewed strength in emerging markets. That's due in no small part to crude oil, which we'll get to in a minute. In purple, small caps actually up 5%, and crude oil really leading the way higher out of all these assets, with the USO up 10.9%. So it's interesting, the three top performers, even those stocks in the form of the S&P, finished the week up about 1.5%. The real gains were in other things. The emerging markets index up over 4%, small caps up 5%. And today was a big up day for the small cap indexes. And then crude oil up 10 to 11%. So that is all sort of the same kind of thing happening. This is representing some of the cyclicals really bouncing higher. The challenge with a lot of things like energy, they're coming off of very beaten down levels. This is a sector that's been underperforming. And even though it gained the most today, it's still lagging behind some of the other sectors if you look at a longer period of time, for sure, because it's had a weak couple of months on a relative basis. Let's finish off our Wrap the Week segment looking at the Mindful Investor live chart list. This is a chart list that I keep maintained on StockCharts TV. To get to this, by the way, it's not too hard. You go to the Articles tab at the top of StockCharts.com. In the upper right, there's a link that says All StockCharts Blogs, and you're going to find mine, which is called The Mindful Investor. And if you look at the top, there's a little button that says Live Chart List that will bring you to this list of charts. You're welcome to save them to your own login. Do whatever you want to them, but I'll keep that list updated pretty regularly. So when we're looking at the market trend model, this is something we review every Friday. It remains fairly consistent here for quite a while. The long-term model has been bullish for over a year. The short-term model has been overall fairly bullish for most of the last 8 or 9 months, really since last September and October. Only a couple weeks where it's turned negative, but for the most part, it's showing the short-term gains that you're seeing week to week, or really Friday to Friday. The medium-term model is what has been much more mixed. Now, I don't have a neutral setting on this trend model. It's basically binary. It's either bullish or bearish, and I did that intentionally because I actually run this model for my own clients on a bunch of other assets, and so I wanted it to very simply be like a thumbs up, thumbs down for a bunch of different things on 3 time frames, just to understand the trend landscape. So the medium-term model for me has been negative since May. And what's interesting about that is if you think about the market environment, I would argue April into May, things really started to change. This is when a lot of individual stocks started to pull back. This is where some of the cyclical leadership, like financials and energy, sort of petered out. Their period of outperformance came off. The FANG stocks, the mega cap tech and consumer names came up to take some of the slack, but and keep the market overall going higher. But the challenge in a lot of individual stocks, they felt a lot of pain there. So the medium-term model has been negative since May for me. That tells me to be more cautious than optimistic in terms of positioning, and particularly on individual positions, and to make sure that I have a good risk assessment in place. What that's done overall is kept me in things that are working. And I think when I'm looking for ideas, or I'm looking for charts that are working, I mentioned earlier the pitch. The 2 sectors that were most widely represented from my 3 guests were 2 sectors: technology and consumer discretionary, by far outweighing all the other sectors. So clearly, there are a lot of opportunities for names that have been in strong trends, but also are continuing to push higher, rotating higher through the course of this week. The daily S&P chart, again, if you know nothing else, look at a chart of the S&P. Is it making higher highs and higher lows? I would argue, of course, it is, making a new all-time high again this week, and today with a first time closing above 4,500. So overall, the trend is clearly positive. So 3 things that I would be looking for on this chart to be less positive. And again, until these 3 things happen, and these 3 things have not happened so far year to date, then there's no real problem with the uptrend. Number 1, we would have to make a lower high, right? We would have to, instead of making a higher high on the push higher, we would have to undercut that. We'd have to make a high below the previous high, which is the first thing we need to do. The second thing is undercut the most recent swing low. So right now, if we would have some broad distribution next week, last week's lows are around 43.60. That would be the level I would key in on, as long as we remain above that. The second item is not checked off, but breaking below that would indicate a downside movement. The final one would be breaking what has served as support, which is the 50-day moving average. That has served as support for the entire year of 2021. It's been tested many times. We've closed below it just a couple times, and every single time we've gone right back above it the next day. So that at some point has to change. We have to stop making higher highs. We have to start making lower lows, and we have to break below the 50-day moving average. If and when all of those 3 things happen, you will hear a great change in tone from me as I get less, taking the foot off the accelerator, more stomping on the brake, and suggesting that we need to think a lot more defensively. Until that happens, it's telling you to stick with the trend, let your winners run. I think a lot of my time spent with institutional money managers taught me that in an environment like this, even though you can come up with plenty of narratives and plenty of reasons why the market should stop going up, as long as the chart continues higher, you want to follow that trend. The trend is up, folks, by any stretch of the imagination. What's interesting, I was thinking of I mentioned my conversation with John Kosar on yesterday's show. It was really, really interesting. He really knows his stuff, does a great job of breaking down the macro environment. We were talking about his Asbury 6 model, and the last indicator to turn bullish was this line here, which is the advanced decline line on the NYSE. So the New York Stock Exchange, much broader group than the S&P 500. You can see the S&P advanced decline line has made higher highs through the course of this year, but the advanced decline line on the NYSE actually peaked back here in June. So one of the many reasons why I've been less optimistic about further upside has been the breadth deterioration, indicators like this actually not confirming higher highs. You can see that I've color-coded these all orange now, because while I don't see them as red, I don't see them as declining anymore, because they haven't undercut that low from July. The August low so far, at the very least, sort of even with that. It's sort of a double bottom so far. they've stopped going down for sure. So I think they deserve to be sort of a neutral amber color. The one that still remains bullish is the S&P Advancers Decliners, which has remained fairly constructive this entire time. These other ones are more neutral right now. I would, if we would see any distribution in stocks in the indexes and think about potential downside, these 80 lines undercutting their July and August lows, I think would be a key confirmation of a rotation lower. At this point, they're holding in there just fine. Let's hit on maybe another chart or two, and then we're going to have to take a quick commercial break. Not everything is perfectly bullish, and again, the market's rallied so beautifully today, and again, I'm concerned about what the Fed is doing. They had this genius move of having sort of the more hawkish governors speaking all yesterday, and then Powell comes in and he's less dovish than he was, but managed to sound a little more supportive than all the people speaking yesterday. It was beautifully crafted. I can only imagine that was a concerted effort to try to cushion the blow of the Fed taking their foot off of the gas pedal, which is what they have telegraphed that they're going to do. That hasn't been reflected on any sort of negativity with stocks. Stocks actually rallied today with the assumption, with the expectation, as Powell implied, that Fed rate hikes would be further down the road. But what you are seeing is that still 4 out of 5 S&P names are above their 200-day moving average. That's fairly supportive. But if it gets below 70%, even though that's still well over half, that tells you that things are starting to weaken a little bit. That tells you that there's a bit of a deterioration in terms of stocks not holding their 200-day moving average. That could be a scenario where the market pushes higher or remains stable, and this line goes lower. And if it remains above 70%, things are still pretty good. I think the indicator getting below 70% back here in February 2020 was one of the many indications that things are starting to deteriorate very quickly. So if you would get a pullback, that's one thing I would certainly look at. Still only 64% of the S&P names above their 50-day, by the way. That's not updated yet for today, but it's worth noting that it's still almost 4 and 5. It's about 2 and 3 that are above their 50-day. 1 out of 3 S&P names still below their 50-day. And it tells you that plenty of stocks still have more gains to be made to participate in this uptrend. It's not completely wholesale just yet. Bullish percent index actually remains below 70%, getting back above 70%, which could happen today into next week, would certainly indicate an all clear and more of a bullish positioning. We talked about sentiment yesterday, so I don't want to beat that anymore, but I will finish our Wrap the Week segment with this chart. This is the consumer offense versus defense ratio. One of my mentors or predecessors at Fidelity, really, Bill Doan, who ran the team in the 70s and early 80s, had a chart like this hanging in the Fidelity chart room. It was looking at consumer offense versus defense. It was a different group of indexes. We're using ETFs here, but the idea was similar. And what's interesting is on the cap-weighted version of this, it's not really breaking out. It's really more sideways. But you have to remember that the XLY is really concentrated in only 3 stocks. About half of the weight are Home Depot, Amazon, and Tesla. So on the bottom one, we have an equal weighted version, which is actually very close to breaking out and confirming a very bullish indication on this offense versus defense ratio.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.